Welcome to vTalkInsight, Market Drivers Daily for March 31st, 2026. Oil has just logged one of its biggest monthly rallies on record. The Strait of Hormuz remains a flashpoint, and yet equities and the dollar are both trying to reprice this shock in real time. Let's start with what today's energy and geopolitical tensions are signaling for cross-asset risk. The dominant story today is that the geopolitical shock has become a full-blown energy regime shift rather than a short blip. Brent crude is up more than 50% this month, marking its largest monthly gain on record and even eclipsing historic Gulf conflict rallies. That move is being driven by the effective bottleneck at the Strait of Hormuz, where around 20 million barrels per day of supply are stranded, and by repeated attacks on tankers, including the recent strike on a fully loaded Kuwaiti vessel near Dubai. At the same time, messaging out of Washington on Iran, whether the United States will end operations even if Hormuz stays shut and what any peace deal might require, has been inconsistent, while Gulf states have made clear they will not accept Iranian control or tolls over the passage. That combination of physical disruption and policy ambiguity is what is embedding a lasting risk premium into crude rather than just a headline spike. Those supply shocks are moving quickly through to consumers and inflation data. Average gasoline prices in the United States have jumped from just under $3 to $4 per gallon in a month, the highest level in nearly 4 years, with some scenarios pointing to $6 in key states. Diesel prices are rising even faster in places like California, and refined product markets, including gasoline and jet fuel, are now tighter than crude itself. In Europe, headline inflation has re-accelerated, with euro area prices up 2.5% year-over-year, the sharpest rise since 2022 and largely driven by energy linked to the Iran conflict. Analysts expect United States consumer inflation to move toward 3.4% year-over-year, helped by higher fuel costs and import prices that are up more than 1% on Asian hardware disruptions. All of this lands on households that are in weaker shape than in 2022, with thinner savings and softer real wage gains, which is why stagflation risk, slower growth with stickier inflation, is back on the radar. On the growth side, persistently elevated oil is expected to drag United States output below 2% and push Europe toward flat growth, with some seeing $140 crude as a key recession trigger that could force the Federal Reserve into rate cuts of up to 100 basis points. There is, however, a counterpoint in the data. Some analyses suggest that, despite the size of the oil move, today's underlying fundamentals may limit the hit compared with earlier shocks, allowing global growth to absorb higher prices for a time. Regional exposure is critical here. The United States is relatively more insulated thanks to diversified domestic and regional sourcing, while Asia and Europe are far more exposed to disruptions in Gulf flows. That underpins expectations that United States equities could outperform during the crisis and helps explain why the dollar has just logged its strongest monthly performance in years, supported both by safe haven demand and by the perception of United States economic resilience. Market pricing around oil reflects this tug of war between physical stress and hopes for de-escalation. Brent is currently holding above $100, and option markets are skewed heavily toward upside calls, with 6-month call premiums rich versus puts, historically a sign that participants expect elevated prices to persist. Scenario work highlights a baseline around $125, spikes toward $150 if inventories keep drawing, an extreme case near $200 if both the Red Sea and Hormuz were shut for even a couple of weeks. Yet oil forward curves show steep backwardation, with 6-month futures trading closer to $80, implying that many traders still assume a relatively quick normalization. Equity markets are swinging between those narratives. Nearly $12 trillion of global market value has been erased this month, but we have also seen the S&P 500 rally more than 3% in a single session on peace headlines, and futures are firm today despite fresh tanker attacks. The dollar, meanwhile, continues to benefit from both flight to safety flows and the view that the United States will weather the shock better than energy importers, reinforcing the petrodollar's role just as Gulf producers lean back toward United States security guarantees. Central banks are signaling that this is not a shock they can fully offset. Federal Reserve Chair Powell has stressed that policy has limited ability to counter supply-driven inflation and that the effects of rate moves would land after energy shocks have faded. As a result, the Fed is in a wait-and-see stance, with no imminent hikes or cuts, even as markets debate whether an oil spike could ultimately force easing. In this environment, traditional hedges are behaving differently. Gold is seen by many as structurally supported by deficits and geopolitical risk, yet the recent pattern, a pre-war surge followed by aggressive profit-taking and liquidity-driven selling, has challenged its near-term safe haven role. Treasuries, too, are under scrutiny as persistent supply shocks make them a less reliable inflation hedge. Some portfolios are leaning more on explicit geopolitical hedges, such as energy exposure, defense and energy security plays in countries like Japan, and on beneficiaries among commodity exporters in Latin America and sub-Saharan Africa. At the same time, a number of investors remain hesitant to radically shift allocations, recalling past episodes when trading every geopolitical headline proved costly. The key watch points now are concrete steps on reopening or permanently repricing Hormuz, upcoming inflation prints in the United States and Europe, and whether today's relief rallies in equities are sustainable or simply another bounce within a higher volatility regime. Those same tensions are already being felt directly along global supply chains. Moving from geopolitics to the real economy, the closure and disruption of Gulf shipping lanes is now a broad supply chain story. With around 20 million barrels per day effectively trapped behind the Strait of Hormuz, physical shortages are emerging well beyond crude benchmarks. Asia and Europe are seeing fuel tightness, and in the United Kingdom, jet fuel shortages are described as imminent, with the last scheduled shipment arriving within a couple of days and no follow-up cargoes confirmed. Jet fuel surcharges are rising globally. Airlines face higher input costs, and some routes could see capacity reductions if supply fails to normalize. Diesel and liquefied natural gas, originally destined for Europe, are being diverted toward Asia, intensifying regional bidding wars and raising the risk of outright shortages in European markets. Meanwhile, energy infrastructure damage in the region could take months or even years to repair, so even if conflict headlines cool, the logistics of getting refined products where they are needed will likely remain a binding constraint. The supply squeeze is not limited to fuels. Helium disruptions tied to the Iran war are threatening production in critical sectors like AI, chip-making, and medical imaging, highlighting how a regional conflict can ripple into high-tech manufacturing capacity worldwide. In metals, strikes on aluminum plants and soaring power costs in the Persian Gulf are creating significant supply risks for global aluminum markets, even though premiums remain stable as recession worries cap demand. Downstream, consumer staples are feeling the pinch from logistics and input costs. Rising resin prices linked to shipping disruptions in the Red Sea have triggered a downgrade in price target cuts for companies such as Colgate-Palmolive, reflecting margin pressure even in traditionally defensive sectors. Overlaying all this is stalled progress on World Trade Organization reform and ongoing trade policy uncertainty, which keeps businesses guessing about future tariffs and currency frictions just as they try to reroute supply chains away from hotspots. These disruptions are feeding into inflation and forcing a rethink of portfolio ballast. United States import prices are reported up around 1.3% on the month, driven by Asian tech hardware and logistics costs, while higher diesel is already signaling a step up in transportation expenses that tend to pass quickly into consumer goods and groceries. In the euro area, the full effect of rising oil and shipping costs has yet to show fully in the data, suggesting that further upward pressure on prices may be in the pipeline even after the latest inflation surprise. In fixed income, persistent supply shocks are undermining the traditional role of treasuries as an inflation hedge, encouraging investors to diversify with a mix of real assets and alternative hedging strategies rather than relying on duration alone. The defense sector offers a good illustration of how supply chains intersect with equity performance. Despite rising budgets and rhetoric, stocks such as Rheinmetall have sold off sharply, in its case by around 17%, as investors refocus on whether manufacturers can actually ramp production given bottlenecks in inputs like aluminium and complex components. At the same time, the shock is accelerating structural rewiring of supply lines. The United States is pushing to secure rare earth supply chains through new domestic projects and international partnerships, aiming to reduce reliance on China and bolster manufacturing resilience. Energy security has become a central constraint for data center expansion, with the location of new AI and cloud infrastructure increasingly dictated by access to stable, diversified power rather than simply land and fiber. Companies and governments are investing in alternative trade routes and logistics infrastructure as insurance against prolonged disruption in Hormuz and the Red Sea, even though the Red Sea remains a viable, if fragile, corridor for now. China provides a contrasting picture. Its official Manufacturing Purchasing Managers Index has just nudged back into expansion territory, helped by government spending and resilient exports of AI-related power equipment and data center hardware, even as domestic services stay soft and further policy support is widely expected. For portfolios, that means supply chain resilience, energy access, and regional exposure are becoming as important as traditional factor tilts. And those same forces are directly shaping the trajectory of the AI boom. Against this volatile macro backdrop, AI remains one of the few clearly positive structural forces, but also one of the least understood in terms of long-term market impact. Overall growth prospects are described as finely balanced. Strong nominal activity and AI-driven capital spending are helping offset the drag from oil shocks, inflation, and the risk of renewed Federal Reserve tightening. AI adoption is increasingly viewed as a genuine inflection point, not just for big technology names, but also for industrials, utilities, materials, and financials that either supply infrastructure or embed AI into their business models. Chinese exports of AI-related power equipment and data center components are, for example, cushioning domestic weakness and some of the drag from global trade tensions, while select European industrial and tech names linked to data centers and automation are highlighted for their robust margins and cash generation despite broader market uncertainty. Capital flows into AI infrastructure are extraordinary. NVIDIA has announced a $2 billion strategic partnership with Marvell focused on silicon photonics to accelerate data transfer inside AI systems, a deal that sent Marvell shares up more than 13% and lifted NVIDIA by over 5%, underlining the market's appetite for AI hardware exposure. NVIDIA is also backing a multi-billion-dollar high-yield debt sale, extending its influence into credit markets as it helps finance the broader AI ecosystem. CoreWeave has secured $8.5 billion in bank and investor financing to expand its cloud capacity, signaling fierce competition in AI-focused cloud services. On the private side, OpenAI has reportedly raised around $122 billion at a valuation in the mid-800s of billions, including more than $20 billion from major tech investors such as Amazon, NVIDIA, and SoftBank. Retail participation is rising via vehicles like closed-end funds and exchange-traded funds that offer pre-IPO exposure, while OpenAI's inclusion in certain thematic funds further broadens its investor base. Despite geopolitical noise, institutional demand for mid-market private equity, particularly in AI-adjacent businesses and data center services, remains robust, even as exit activity stays muted outside a handful of high-demand assets. Beneath the headline growth story, AI is also a powerful source of disruption risk. Rapid advances are enabling dramatic workforce reductions, with anecdotal evidence of teams shrinking from 8 people to 1 as automation takes over routine knowledge work. That boosts productivity but raises questions about medium-term employment and consumption. Big tech is no longer viewed as a simple defensive haven, as investors worry about valuation stretch and whether AI will erode the pricing power of incumbent software models. NVIDIA's own leadership has hinted that enterprise software margins could compress as more value accrues to compute and energy rather than pure code. Credit markets are beginning to reflect those concerns. Leveraged loans to software firms now carry a clear AI disruption premium, and there is growing discussion that credit spreads could widen as job losses and equity outflows feed back into corporate fundamentals. Rather than shorting large-cap tech outright, some strategies favor convex hedges in credit indices or exchange-traded funds, aiming to protect against an AI-driven repricing without betting on precise timing in single names. Market structure around AI has also shifted as macro headlines have dominated the tape. Since the Iran conflict escalated, volatility in many tech and AI stocks has actually collapsed, with correlations rising and broader volatility indices, such as the VIX, moving higher as macro rather than stock-specific factors drive trading. AI-driven brokerage platforms are another emerging force. Models like the AI agents at Public.com are already executing complex option hedges and income strategies on behalf of clients, with about half of user interactions reportedly resulting in a transaction within 24 hours. That points to a shift back toward full-service, highly automated brokerage, with the potential for higher turnover and different patterns of liquidity during both risk-on rallies and drawdowns. Looking ahead, key markers will be upcoming United States bank earnings and manufacturing surveys, which should reveal how much margin pressure is coming from energy and AI capex, the pipeline and pricing of major AI-related IPOs, and how energy security constraints influence where the next wave of data centers is built. In short, AI remains a powerful support for the growth narrative, but it is also reordering sector leadership, credit risk, and even market microstructure at the same time that geopolitics and supply chains are in flux. To wrap up, today's price action underscores three connected forces. A historic oil rally and unresolved tensions around the Strait of Hormuz are reshaping the global inflation and growth outlook, driving dollar strength and a more volatile, headline-driven equity tape. Those same shocks are rippling through supply chains, from jet fuel and diesel to helium, aluminum, and packaging, weakening traditional hedges like treasuries and putting a premium on resilience, regional diversification, and real economy bottlenecks. At the same time, AI remains a powerful structural tailwind, attracting enormous capital into chips, cloud, and private platforms, while also introducing new valuation, labor, and credit risks that are only starting to be priced. Tying these threads together, the key is how far energy disruption persists, how quickly supply chains can adapt, and whether AI-driven growth can continue to offset mounting macro headwinds. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.